Private mortgage insurance, also known as PMI, is required anytime a home buyer is putting less than 20% down for their down payment on a home. There's several different ways the PMI can be paid, though. The most traditional way is for the borrower to pay it on a monthly basis. And you pay the PMI, and in most types of loans, you pay the PMI until you have 20% equity in the home. At that point, the PMI is removed and your monthly payment actually goes down. Another way that's becoming more popular is for the PMI to be paid by the lender. And in this case, the borrower doesn't ever pay any PMI. The way the lender pays the PMI is by giving the borrower a slightly higher interest rate on their loan. This allows the lender to pay the PMI up front. And even though the interest rate is higher, having no PMI usually ends up giving the buyer a lower monthly payment. So it's great in a scenario where you may only be owning the home for 5 to 7 years and you're putting down the minimum down payment. In a case like that, you would probably never be getting rid of the PMI if you were to pay it yourself on a monthly basis. So over that 7-year period, your monthly payment is going to be less than if you were to pay it yourself. So that's becoming more and more popular, especially with first-time home buyers who know they may not be owning the home for too long. So there's a lot of different options for PMI, and the key is, you definitely don't need to put 20% down to get a good loan.